Hey everybody, good afternoon. Marty Missouri here, 23rd of August 2024, Friday, with a very quick video update for you. There's a lot we can talk about today. I'm just going to breeze through without showing you a bunch of charts. The highlights from our weekly scoring of our PWA General Conditions Index. Do want to talk about the equity markets. Do want to share my thoughts on kind of the personality of the market as I did in the written blog here the other day. And make it substantive, but not keep you very long is the goal today. So with regard to our PWA index, it scored a negative 39, and that's the lowest it's been since July of last year, when everybody and their uncle was in the recession camp. And of course, it was the recession of 2023 that did not happen. Many people have abandoned that because it was such a bad call this last year. I think we learned a lot about what kept a recession from happening amid an environment where Bloomberg, for example, Bloomberg Economics said 100% chance of recession in 2023. Looking back, we can discuss why. It's not hard to point to excess savings that existed longer than most of us thought would. Immigration into the U.S. actually led to greater consumption. You can talk about what that did or did not do for the employment market and so forth. But there were factors that were maybe unanticipated or were maybe off the beaten path of analysis that led to the economy holding up pretty well in 2023. I must say that one of the economists who research we pay for, who said no recession last year, now says very firmly a recession will start either toward the end of this year or early next year, and they provide lots and lots of data to support that view. And it's consistent with a lot of the data that we are seeing that support our view that recession odds are too high for comfort right here. In terms of what changed or what I highlighted to discuss today, the leading economic indicator to coincident indicator ratio declined a bit. It's still very much in that historic recession territory for us. The Chicago Fed National Activity Index went negative with only 28 of their 85 data points positive, 57 negative. The U.S. Economic Surprise Index dipped deeply into the red at a negative 45. The Bloomberg Commodity Index was negative. Commodities are flashing something not so good about the economy. Sector to S&P 500 ratios. The only things that beat the S&P this last month were staples, utilities, healthcare, and tech. By the way, tech did with their recent rebound, but all of the cyclical, economically sensitive sectors underperformed the S&P. That's a negative statement about the state of the economy from the equity markets. So that big Bureau of Labor Statistics revision for the last 12 months, 881,000 is their preliminary estimate of how wrong to the downside the monthly numbers were. Now, by the way, anybody who's a conspiracy theorist, it's the same organization that comes up with the monthly numbers. And by the way, these constant negative revisions are consistent with the revisions that exist heading into recession. Coming out of recession, at the beginning of up cycles, you tend to get positive revisions as more data come in. So negative revisions, a lot fewer jobs were created apparently than the monthly data originally suggested, but that's very consistent with our overall thesis about the strength or lack thereof of the economy. That makes the average last 12 months about 170,000. And BCA researchers, experts in this space, say that that's about what we've needed just to keep unemployment steady. So not the big, robust economy that many people see when they're going to, concerts and other venues and hopping on planes and high-end restaurants. In fact, I will show you a data point there that suggests that the upper rungs of the income ladder are doing fine, but the lower rungs are actually, I would say, quite desperate right here. And again, that's not a good picture or a go-forward picture about the current state of the economy. So in front of you, though, is the live chart of the QQQ, the index that tracks the NASDAQ 100, or the ETF that tracks the NASDAQ 100 index. You can see in the futures market, we got this big gap up right here. As the text was released of what Jerome Powell was going to say at the Jackson Hole Fed meeting, stocks began to ramp up quite nicely. You can see that the Qs peaked way up here, well above 480, promptly went down, filled that gap from earlier, and then danced around and found support at that level and closed right here at really what was key resistance that we have charted here. In fact, let me expand this out a little bit. Let's go the hourly chart. You can see how important this level here was for support, and you can kind of see how important that level was for resistance. In fact, I'll just go to the one-year daily chart. So right up in here, key levels, lots of action, a lot of volume up in here. So it looks like we're closing pretty much right on the button of that resistance. Doesn't really say much about what to expect next week. I'm sure there was a lot of options positioning that had to be cleared, and that's essentially where the market got pinned, was right there at 480. So folks, we will see. Recall, I think it was a week ago Monday when we had that big meltdown, and I said, hey, look for this market to recapture that even over the next few days with some commentary. And we got very bullish commentary, or necessary for markets commentary, out of the Bank of Japan. And then we got it, today with Jerome Powell, and we got the anticipation of that. Now, one thing I did notice this week is that while stocks were more or less rising, the VIX, up until yesterday, the VIX really spiked yesterday, but the VIX was rising as well. So that suggested to me that folks were buying protection, perhaps on, it could be the jobs number or the revision of the jobs number, but they kept buying it leading up to today. So when you're buying put protection, for example, there's a dealer out there who's having to short the underlying securities. So if you're buying puts on the S&P, they're shorting the S&P index futures. And when Jerome Powell's speech, when it became obvious that he was going to give the market what it wanted, we had massive covering. And so we saw that thing just shoot straight up and then establish these levels in here. So it was a nice day for stocks. I am absolutely not complaining. But folks, a lot of skepticism around whether or not the fundamentals justify these valuations or justify a sustainable longer-term up move from this juncture. Just one firm's opinion. Those of you who aren't clients, this is not advice. Okay, I could give you more of the technicals. The divergences, bearish divergences, and the momentum indicators are still there. So even if we do hit that all-time high, which wouldn't surprise me over the next few days, in fact, that or coming back off of these levels next week wouldn't surprise me either, to be honest with you. But if we do pierce into new all-time highs, it's going to have to be quite the run before we burn through what are still bearish technical divergences on the momentum indicator. So on the blog post that I wrote on Tuesday that clients received on Wednesday, I titled it Underpinned by Emotion and then Signs. You'll see what I mean here in a second. So thinking about the kind of the collective personality of the market, institutional trader, hedge fund manager, and so forth, and how they live and die by their running profit and loss statement. Those who are experienced, thoughtful, and objective, I'm assuming know that we're late cycle and that valuations are extended and the potential for something consequential to the downside for stocks is there in the not too distant offing. Nevertheless, we're not there yet. The dips get bought, and based on, like, for example, the Bank of Japan's job owning after that big sell-off that they largely caught the blame for, and then what I anticipated today, which we got, the powers that be, or the powers that wield policy, don't have much stomach for downward volatility in financial markets. So despite the ever-rising risk, today's trader essentially has to, as I say here, rock to Chuck Prince's tune from 2007. As long as the music's playing, you got to get up and dance. 30 months after that statement, his stock was down 95%. Not a prediction at all, just saying. Okay, so now in today's extreme market myopia, 2007 seems like an eternity ago, And so I'm wondering how many professional traders were actually in the market 17 years ago, let alone last time valuations looked this high, which many of the valuations do, is the 90s tech bubble peak. And for those who were, do they think that maybe this time's different? I mean, I could see why they think that based on what they did around COVID in terms of printing and spending money. So perhaps maybe this time is different. Ultimately, I'm not in that camp, and I think there's some serious career-ending risk for those who are too myopic right here in the professional space. And that would be, of course, if stocks do reprice. And then we have the retail trader, you and me, the everyday investor. I worry greatly about the message, the perpetually unsuspecting, please forgive me, but that's just reality, unsuspecting at tops and bottoms the retail player has received from post-COVID action, i.e. buy every dip. Now, I can't forget, though, that the market went down 33% during the course of 2022. In the words of the great Sir John Templeton, he said this in August 2000, the impact of expectations underpinned by emotion adds up to a trend in stocks. People who attest to a singular nature of our current bull market, that was before the market rolled over then, ought to know better. Lessons of history are clear. All bull markets come to an end, typically when people are most optimistic about the future. Over and over and over again, folks, if you study history. Grant Williams' podcast, you got to pay for it to watch it. You have to be a subscriber. Excellent stuff. He and Bill Fleckenstein, they hosted James Aitken, who is a serious market and macro player. People pay him lots of money for his insights. They covered a lot of topics. I highlighted what was consistent with my message this week. And that is that people, particularly the newer generation, the past 10 or 20 years, assume that all prices will be continuous at all times. U.S. market structure, of course, has that same thing priced in. I think that's the thing people that haven't been around a long time, haven't seen this, don't appreciate. And you cannot assume that any price will probably be continuous if the wrong things happen. That was Bill Fleckenstein. Aitken says he read the other day that maybe 45 million new accounts have been opened since COVID. That's unbelievable. And essentially, let's go ahead and blow up another bubble so we can muddle through. And that's what's happened so far. So he said, let's be conservative and say it was 30 million new accounts and that 10 million are active all day long. What the hell? 10 million active accounts? Gosh, that's not a healthy situation. That's 10 million people who could be productive, right? No, we're going to trade on that. Okay, well, the casino is open every day, and it's an unhealthy state of affairs. But you know what, folks? It's going to keep going until it stops, and it could go further. My view is that the odds of this not all ending well are way too high for comfort. We're going to remain diversified and pick our spots. And I'm not complaining, don't get me wrong, but I have my concerns, and obviously I have my doubts. Okay, then lastly, and I'll stop here on another note, as I mentioned, clearly folks in the upper rungs of the income ladder have been doing the heavy lifting for the economy for quite some time now. Of course, by definition, nothing lasts forever, right? In a cyclical economy. Jesse Felder featured a chart. I saw it on the Daily Shot as well. Shopping for rooms, flights, and cruises slow. And this is important kind of leading stuff. You can see that those things have been rolling over on the internet searches during the month of July. And then what about the folks who find themselves on the lower rungs? And I mentioned their desperation. The New York Fed survey came out this week. Expectation of losing one's job is at a record high, particularly for younger folks under 45, folks who make less than $60,000, and for women. So, folks, I don't know anybody who would tell you that this economy is in great shape, that the rest of the stocks are going to catch up. 100%. I appreciate where they're coming from. I can understand their narrative, but if they're just telling you that verbatim or exclusively and not digging a little bit under the surface and pointing out these things that we're pointing out here and not investing accordingly, well, good luck to them. May turn out great. History suggests that maybe there's some risk here that we need to very closely consider We never know for sure what the market has in store in the near term, but I think we can do a good job at assessing the underlying risk, macro risk globally at any given time, and that's what we attempt to do here day in and day out. Folks, thank you as always for watching and listening. I hope you have the best of weekends, and I'll talk to you next week. Bye-bye.